It seems that everyone out there is saying that you'll get a guaranteed 10% return if you invest your money into the overall market. I'm just gonna give it to you straight right now. You probably won't. If you're an investor, it might sound kind of alarming to hear this, especially if you're banking on double-digit returns for your retirement or financial goals. So let's dive in and break down why exactly this might be the case and what you can do about it. To understand why future returns might not hit that 10% mark, we need to look at the historical performance of the S&P 500. Over the past century, the S&P 500 has averaged around a 10% annual return, but this includes periods of both high growth and significant downturns. There's also one key thing that most people are missing when they look at this number. They're missing the multiple insane bull market runs from 2008 all the way up to now. Most of the multi-year bull markets saw extraordinary returns, often well above the 10% annually. And just in the past couple years, we've seen triple the overall average. These types of growth periods are not always sustainable, so we need to look at some factors that affect future returns. One of the most important factors is valuation. As of right now, the S&P 500's price to earnings ratio is over 50% higher than the historical averages. High valuations can indicate lower returns because stocks are already priced in at a premium. And historically, when the market becomes overvalued, returns tend to revert to the mean, which means that lower future returns may be possible. Another big factor is tied to GDP growth. The stock market's growth is correlated very closely to economic growth. If GDP growth is slow, corporate earnings will also be slow, and this can lead to lower stock market returns. Since the average annual US GDP growth has been under 2% for the past 10 years, it's hard to make sense of the market continuing to grow at such a pace compared to its GDP growth. Economic growth in the near future can also be highly impacted by unseen issues like geopolitical tensions, pandemics, other global uncertainties. So in some way, every single investor should keep these things in mind. And here's something that has been one of the more recent factors that affect market returns: the federal funds rate, which has a direct impact on economic growth and inflation. Higher interest rates can lead to higher borrowing costs for companies. This in turn could reduce their profitability. Additionally, higher rates can make bonds more attractive to investors compared to stocks. And high inflation can erode purchasing power and corporate profits. While some inflation can be beneficial for stocks, runaway inflation is completely detrimental. All these factors can in turn affect corporate earnings. For the S&P 500 to deliver high returns, companies within the index need to consistently grow their earnings. With mature companies making up a significant portion of the S&P 500, explosive earnings growth becomes challenging. The increasing labor costs, supply chain disruptions, and other operational challenges can squeeze profit margins. This can lead to lower earnings growth overall, which in turn will lower stock valuations. And I'm not just spreading fear, uncertainty, and doubt. Many financial experts and institutions are projecting lower returns for the S&P 500 over the next decade. Vanguard has projected that US stocks might return between 3 to 5% annually over the next decade. GMO predicts negative real returns for US large cap stocks over the next 7 years. And JP Morgan's long-term capital market assumptions forecast returns below the historical average for the next decade. So what does this mean for you as an investor? This means that you need to start diversifying your assets and even consider broadening your portfolio to include international companies. Emerging markets and non-US developed markets may offer better growth opportunities in the long run. You may also need to make sure that you have exposure across different asset classes, including bonds, real estate, commodities, to balance the risk and reward of your portfolio. The focus also needs to shift toward value, specifically undervalued stocks with strong fundamentals. Value stocks have historically outperformed growth stocks over the long term, especially when starting from periods of high valuations. And while passive investing in index funds has been popular, you could consider allocating a portion of your portfolio to actively manage funds or strategies that can adapt to market conditions. If we look at historical return outcomes, passive investing may not get you the returns that you've planned for over the next decade. And overall, everyone may just need to adjust their return expectations to more realistic levels. Planning for 5 to 6% may be more prudent in the current market environment, especially if retirement and savings goals have been based on previous year returns. During this time, it may be wise to increase your savings rate to compensate for potentially lower returns, as this can help you reach your financial goals even if market returns are below average. While the historical 10% return of the S&P 500 is a tempting benchmark, several factors suggest that future returns may be lower. Higher valuations, slow economic growth, rising interest rates, global uncertainties, they all point to a more challenging environment for achieving double-digit returns. By diversifying, focusing on value, considering active management, and adjusting your expectations, you can better navigate these potential headwinds. Anyways, make sure to drop this video a like, share it with anyone who needs a reality check, subscribe if you haven't already, and I hope to see you in the next one.